in San Francisco. And I think, is it Dylan Radigin? It's been so long. In Milan. Good to see you again, my friend. We're here to take you through the rest of this hour as we work our way through this Fed meeting day. Market closes at 5 p.m. Eastern. If you're on the platform, if you're on the website, tastylive.com, thanks for joining us. Why don't you come over to YouTube, join the conversation, tell us what you're trading today, what you think of Fed Chair Powell's selection and the words that came out of his mouth. Ilya certainly has a lot to say about that, as do I and Dylan. But let's break down the market action as we look at the damage here, which after the press conference, we basically were unchanged from the start, sitting around 56.20 or so in ES. Just into the close, we get an announcement from President Trump that they are rescinding the curbs on chips for AI. So the market now back to 56.52. So net kind of closing closer to the highs than the lows, Ilya. Mm-hmm. What did you think of what Powell said, though, and his commitment to being non-committal?
Yeah, so we were just talking on last call there about strategic vagueness. And I think that's really the takeaway here. It's sort of what I was expecting as I was writing about this yesterday, thinking that what the market wants is a little bit more urgency because they're looking at the survey data that the Fed chair, by the way, painted with flair and color. I mean, he was out there really going through the data, saying, here's the GDP number. They actually flagged the distortions in it in the statement, saying, here's why this is a foggy GDP number. Here's the labor market data. Here's why that's foggy. Here's the service data. Here's why it's god-awful. And saying, yes, we see it. We know. And we know that the tariffs are the reason that we see it. We got it. And there's nothing we're going to tell you that's going to change any of this because we don't know any more than you do how this lands, which was exactly a rehash of March, where the Fed updated its forecast and said, we know that this probably or historically has meant lower growth and higher prices, increases in tariffs, but we don't know how this particular episode is going to work out, so we're not going to do anything until we know. And here they said exactly the same thing, only they said the risks to going in opposing directions on growth and inflation have increased. And that's it. And thereby kept it maximum vague.
Who could know? Who could know?
But this is the whole thing. So the markets wanted a little more urgency. They wanted for the Fed to lean in the direction of 3 cuts this year, then 1 follow next year. The Fed in March told them 50-50, 50 basis points this year, 50 basis points next, so 2 and 2. Markets wanted help sooner. They didn't get it. So when this came out, it was mildly disappointing. Stocks went down. Bonds at the long end especially went up. Those moves have since kind of evened out. And probably the only upshot that we get so far is a little bit of a stronger dollar, but not really one that's running away anywhere. Still kind of within the ranges. So on the whole, I think the markets felt kind of mildly deflated by this. And now we'll see what happens going forward. Encouraging, this was not.
Granted, it was a 2% chance of a rate cut today, so I don't think anyone was really expecting much of anything out of the policy statement. Still, in the press conference, doesn't seem to be one that really moves the market. I mean, I'm looking at ZN here. We're trading in at 111 and 16 ticks before the Fed decision's released. Here we are now at 4:09 p.m., where we're trading at 111 and 16 and a half ticks. The bond market held up, so I guess that's the good news. What do you think of what Powell's doing now that the Fed can't really act in the short term?
I mean, I think honestly, it enhances the central bank's credibility because it makes them appear to be remotely honest in saying, "Who could know?" And that is, I don't know, is an answer that can only be given by someone who actually wants to maintain their credibility. And so I would argue that saying "I don't know" and "we don't," who could know, is a very credible position right now. It doesn't. What it makes me wonder is, So I've got an equity market that basically is saying, listen, whatever happens, it's going to be fine. And Trump's going to these deals are going to get much more, much less damaging to global economic activity. But you still have a dollar that's, adjusted structurally to a lower global valuation. And I know gold's been going the other way, but you still have this sort of gold situation. Like, I just feel like the market isn't. There's a lack of harmony in the messaging of the value of the major securities markets that I find perplexing. Maybe it also makes sense because it's part of not knowing. When you don't know, everybody's allowed to have a conviction. But it does make me wonder, like you talk about selling a call spread on the rally today, Chris, if there's a trading opportunity, like if something is wrong, either equities are wrong, gold is wrong, something is out of order. That to the degree to which you can sort of get decent pot odds on what that thing is, and maybe that thing is equity markets are now at higher levels, and that there's more likely to be an equity sell-off than there is anything else. That seems as good a bet as anything.
Mm-hmm.
I mean, I listened to this press conference today, and certainly he offers some optimism, right? He talks about the distortions, and if you strip away all the noise, the inventories, the government spending, the trade figures, then you look at an underlying economy that's still growing pretty solid. So he's not screaming that the situation in the hard data is terrible right now. But what he is saying is that it pretty much means nothing because they don't know where the data is going moving forward. He conceded that the tariffs that were announced on Liberation Day were obviously much higher than what was discussed publicly. The research that he read, what ultimately private markets, private individuals like us were led to believe would be the case. So there was a period of shock and adjustment. And it's totally feasible that we're out of the woods if some deals come together, but who knows? Who can know, Dylan, as you say. I find this little bump here with the market responding to Trump's chip restrictions coming off the board. That's a decent little bounce here. How much carry through does it have overnight? I don't know. I will say that I'm looking at this market on the short side now with that reaction here, Dylan. You just alluded to it. Ilya, you and I have been talking the last few days about how the market would behave right up around this 57.73 dot quarter, April 2nd swing high level. You also have the 618 retracement of the yearly high-low range around there.
Yeah.
I wanted to sell a put spread up just north above those levels in the ESU 5 contract 44 days out. Simply put, because if I'm looking to harvest vol, a short call spread offers better risk to reward than a short put spread here. Mm-hmm. And after the press conference with the market bouncing, I said, you know what? I was trying to get filled on futures power hour. I couldn't. Do I want to keep this going? Yes. Okay, I could get filled. I still like the risk to reward here being short when the guy who controls the levers of the economy says they don't know where they're going, and it's not for a good reason, with a lot of warning that while he doesn't want to speculate, the downside risks have increased. I don't know if the headlines are going to be able to carry the market here. Although, again, it's very sensitive. Are we going to get any new significant developments between now and when the U.S.-Chinese delegation meets in Switzerland? I would say probably not on that front. So
I think that actually makes it likelier that the bearish case wins out. Because if the markets get their opportunity to digest what this means, it's very clear that the markets know what's coming. Like the Fed is waiting for evidence that the Fed can sell. That makes sense. The Fed is under tremendous political pressure. It isn't in a position where it could, with impunity, say, look at the data. This is obviously recessionary. We need to pick a side. We need to cut. They don't have that. They don't have it on the inflation side. Inflation has cooled, but momentum in disinflation is not anything to hang a hat on. February was a big spike in annualized 3 and 6 months rates. We came down in March, but it's 1 month of improvement. That doesn't tell us anything. So when we look at sort of the breadth of it, the Fed understandably is waiting to make a call, and really is throwing the gauntlet in some respects to the White House and saying, I don't know what you want from us. All of the stuff that you're all worried about in the activity surveys, that's linked to this. That's not us saying it. Read the surveys. I mean, he's naming names and pointing fingers in this press conference and saying, this is what it is, and our hands are tied. Go talk to them over there if you want to know more. But the markets have made up their mind, because if you look at break-even rates, they're actually moving lower since mid-February, the same time that stock markets turned. And it's because they're looking at what the tariff price increases will do to growth, looking through those price increases and saying the demand decline will be more significant and will offset and give you net lower inflation. The Fed really should be prioritizing growth. The markets are already making this call. Moreover, this is why Fed funds futures.
The markets are making the call that the Fed should be prioritizing growth?
Yes. Yes.
Meaning they should be cutting?
Yes. Yes. And the Fed understandably is saying we have to wait because we need to make absolutely sure, especially with the political pressure being elevated here, that we can really sell it, that we are beyond reproach when we go. And they don't have that kind of hard data. It's completely understandable.
I completely agree.
But the markets have already made the call.
Which is growth is the thing, cut rates don't. Tariffs are the issue, growth is the risk. The hell with inflation, cut rates.
We've been on this for weeks, Dylan, right? This stupid thing that I do with this pen where it's like the Fed thinks inflation's going this way. It's a one-time adjustment. It keeps going up, so they ignore it. And then they think about the decline in real output on the other side. I mean, Powell's telling us clear as day, like, we can't move on that yet because we don't know how persistent the inflation impact's going to be. But once we can quantify that in some form or fashion, because the tariff levels, they continue to change. I as like a kind of a sidebar here, I think what happens with the U.S.-China negotiations is the tariff rates are going to be dropped back down to like 50%. Trump's going to call it a win, but a 50% tariff on Chinese goods is still going to be inflationary and growth negative. It just won't be that inflationary compared to the baseline of where we are. And it will allow the Fed to then say, okay, maybe we should act. But this is the Fed's whole shtick. They would rather be late so they have confidence that they're moving in the right direction than risking being early and moving the wrong way. Because let's say they start to hike right now, and in that scenario, they say, oh, inflation's coming down the pipeline, cuts are off the table for the rest of this year, and then EU and China come out and say, actually, we're going to give Trump everything he wants. We see the way that he sees the world. We've been ripping you guys off. Our bad. Right? Well, then the Fed just took rate cuts off the table, and now, well, that was silly. They're going to have to start cutting again, and now their credibility's harmed because they took such a strong stance and have to reverse. So the incentives here are for the Fed to do nothing, say nothing. What was it from Arrested Development? That boys' school, like children are neither seen nor heard. Like the Fed wants to be neither seen nor heard right now until they get declared.
More information.
Yeah,
everyone knows that.
Unless and until, essentially.
Right. And that's been the clear message from every Fed speaker. On the other side of this blackout window, by the way, we have 6 Fed speakers coming up on Friday. They are really going to be hammering home the messaging for how we should be approaching the market here. So we can see on this 4-hour chart, the NASDAQ, it's hovering right around that April 2nd swing high. It's struggling below the 618. I suppose if we want to be generous and say, like, if this thing is going to break out technically, because technically it still has some strength to it, maybe this is a bull flag coming together up here in a very, maybe on a 4-hour chart. I don't know. You could make that case, though. Maybe it's the start of a head and shoulders pattern, left shoulder, head, right shoulder that's coming together. Again, this is kind of the line in the sand for bulls and bears. Whoever wins here in both ES and the NASDAQ, I think controls the market for the next 5%. Directionally, one way or the other.
Yeah, I think that's right.
Right. 250 points. Right. Back to 5,400 on ES, maybe up to 5,800, 5,900.
Yeah. Yeah, I mean, that's really the key here. You are at the deciding line. They have to figure out what they think of all of this right here, right now. And I think if you look at the daily chart on ES, what you see is a test of former support become resistance, a very clear evening star candlestick pattern. If you want to go sort of pure price action, forget macro, who cares and who knows. A clear bearish reversal signal, and today an attempt that retests into its bounds that fails. And what that looks like then is, let's say if you want to be aggressive, a short. Let's say if you don't want to be aggressive and wait for some degree of confirmation, then you're looking at that point for a break back below, let's call it 55.60. Something like that. 55.60, 55.30 as a range. And if you break that, that's basically the spike from the reciprocal tariffs 90-day pause. That's your line in the sand. You get under there, and it's a very convincing short.
Before we head over to the other asset classes, sector performance today, particularly in the wake of the Trump rollback on the tariffs, looks very growthy. SMH is your top performing sector, up 2.05% into the close. XLK is up a 1% figure. You have consumer discretionary up 0.78%. And retail, XRT, up 0.72. This is the one that really intrigues me. I don't know who listened to the Scott Bessent testimony today, because, you know, some of us enjoy putting bamboo under our fingernails for sport. I hate listening to congressional testimonies, but sometimes you just got to dig through the noise and people shouting over each other to get some answers. Bessent was pretty clear that he does not see us bringing back textile jobs to the country as a result of this tariff strategy. Right? The goal here isn't to make shoes and sweatshirts in the U.S. The goal here is to, again, rebalance so that you have high-end consumer textile manufacturing happening here, like luxury goods, the LVMHs of the world, Dylan, not the Reeboks. So maybe they're looking for off-ramps.
I mean, obviously they're looking for off. I mean, this whole thing is a joke.
Well, let me give you two aspects of this joke here, Dylan, that I think I want to get you riled up on, which comports well with what you said today on Truth or Skepticism. Two pieces of information have been corroborated by different news outlets, which I know the chat's going to say fake news. That's fine. One of the sticking points in tariff negotiations, countries that don't currently allow Starlink are being pressured to change their regulations to allow Starlink access to those countries. And Vietnam, according to Bloomberg, has floated allowing the Trump organization to build a building in Hanoi City in exchange for taking down the tariffs. Do you have any thoughts on these particular news items, Dylan?
It's always predictable, expected, and speaking of today's discussion on Truth or Skepticism, this sort of the final extension of the corruption of the presidential office that's been ongoing since the 60s. And now it's just the most blatant and exploitative and profitable and conflicted that it's ever been. And the difference this time is that that the entire global economy has been taken hostage to facilitate the preferences of the enrichment of the president, which is a new level. But at the same time, listen, the stock market could easily be right here, which is that there's going to be a bunch of trade deals. That apparently the 90 days times out on July 4th. Is that possible? I mean, this whole thing is maybe just set up for total theater. So this whole thing may have been back timed by a bunch of television producers from July 4th back to April 2nd with a plan for crazy tariffs, a week of chaos, a 90-day pause, which sets up July 4th, 3 months of deal making and lots of attention and control of the world's attention every day for 90 days, including the markets, and then a gigantic 4th of July super party when Trump does a final liberation of America on the 4th of July with all these new trade deals, which are the same as the trade deals that existed on April 1st. The whole thing is theatrics.
The theatrics are certainly there.
Which is why the Fed chief is saying, don't ask me.
So, by the way, one interesting thing that the president said in his either the second to last interview or the most recent one, he's done two of them recently, was he doesn't need for anyone to sign deals with the U.S.
And we talked about that yesterday. Yeah,
that was an interesting perspective. Like, he doesn't need them to sign them because, of course, there's the question of, okay, well, you negotiate a deal, then it has to be ratified by parliaments on both sides or legislatures, as it were, on both sides, and that's a lengthy process and haggling and blah blah blah. He's like, I don't need anybody to sign anything, which implies that what he's looking for is basically a wink, a nod, and a handshake, and then he'll unilaterally
maybe a building permit in Hanoi,
and maybe a building permit, and he'll unilaterally undo the stuff that he's unilaterally done. And so, to Dylan's point, the foam board was a one-way thing from the U.S. Maybe on July 4th, he just sacrificially lights it on fire to great cheer and hopefulness, and that was that.
Fireworks, literally, giant fireworks.
Next episode, heel turns hero, season 2.
Okay, and then run tax cuts in the fall.
All right, so I have
season 2.
One of the reasons why I feel so bad for kids in college these days. When I was in college, Osama bin Laden was killed. My fraternity used to stockpile fireworks from Phantom Fireworks in Easton, Pennsylvania. All right, and so when Osama bin Laden was killed, obviously we took all of our fireworks off and spread them all around campus, all over the campus, and launched them all at the same time, right? We're all running in the quad, waving American flags. It's a fond memory of mine. I called Phantom Fireworks. Yeah, we killed bin Laden. You think we gave a shit about the rules that night? Plus, the cops couldn't respond to 6 different fireworks sites going off all at once. Like, where are they coming from? I called Phantom Fireworks because I'd like to get some fireworks for 4th of July. And they told me their costs are through the roof, like doubling of all their fireworks prices, which just kills me.
Because of tariffs?
Because of the tariffs, because they're all made in China.
Oh, man, fireworks that's are fantastic. Made in China. That's genius.
So how are we going to celebrate July 4th?
We'll do a drone show. The modern fireworks are very, last year, bro. Like the new thing, and it's been the new thing for a few years in Dubai and Shanghai, is you don't do fireworks. You do the world's most spectacular drone show. You know this.
You do the drone show though, because it's a flex of your military power without having to do a military parade. If you can have all these, like China doing all these drone shows, to me is a flex of their military and technological might. That like, hey, if we can do this with these kind of drones, like imagine if we had all these drones with bombs on them. I think that's the clearest signal to me. They're showing
I did think that when I was in Dubai watching all those drones, I was like, imagine if all those drones were not just flashing lights, but were like, had malicious intent.
Mm-hmm. Mm-hmm.
So I did have that thought. I'd never seen the drones in Shanghai, but in Dubai, it was quite a thing, I'll say.
Dylan, so let's just take our ridiculous TDS to another level here. We posited back a while ago that if the first buddy is going to be the first buddy, maybe we aren't bullish enough on Tesla. And that's, of course, before the guy torched his reputation. But I could argue that you have a 1, 2, 3 triple bottom maybe coming together here. And Ilya, it's a pretty nice catch against the 1 month moving average here today. Doubling of the range in Tesla is about an 80-point move. And so looking towards 370, 380, which happens to be the bottom side of the trading range at the start of January and beginning of February, that would take you right up there. There's part of me, Dylan, that's seeing all this news flow and saying, screw it. Stop worrying. Learn to love the bomb. This is going to happen. We're just going to ride this up to the upside. So why not like a 375, 400 call spread in Tesla?
I like it.
risk $90 to make 2,400, go out far enough so if we do break out and stocks are enthusiastic, and mine and Ilya's bearishness on equities and Powell being not even a drunk driver, just a blind driver with Fed policy in the short term, none of that matters. We're just going to ride higher on hope, which, to be fair, hope's a good thing. Hope's the most important thing. If you're
a really powerful motivator.
Got us this far.
Why was the market rallying in April, May, June of 2020?
How do you explain the last 10 years?
Yeah, kicking the can down the road and more hope. And that's what equity markets like and want. And there is also, Ilya, we need to consider this, and I appreciate John Farrow and Tom Keene on Bloomberg Radio talking about this after the Fed meeting today. They kind of dismissed it, but what if this is a market and an economy like 2022? How much hand-wringing was there in 2022 about how, the stock market's going down and these policies and the Fed's tightening and recession is guaranteed. Guaranteed, right? The 3-month 10 spread goes up to what? The New York Fed recession probability indicator? 90% chance. The 2 10s invert. Recession's definitely coming. And it never did. And so the market shot right back up. If the recession never comes, there
are very big differences.
Of course there are. And I'm not discounting them, right?
Yeah.
But, Powell himself today kind of spoke to, we could just muddle through. And I don't think that's priced in where we just muddle through and the worst doesn't happen and we don't get the reshoring of manufacturing, but we also don't get an economy decimated. We get one that's kind of bleeding out from like 1,000 cuts rather than making big directional breakouts. I'm obviously short now, so hopefully it goes down a little bit more in the next few days. But I got to say, I have very little conviction here in stocks, guys. Very little.
But I think that's a good sign. I mean, I just think that anybody who has conviction about anything right now outside of somebody who knows what the Trump administration is going to do next is somebody I think you should question.
Well, and that is exactly why the bias should be bearish. Because if nobody has any idea what's going on, then the question becomes, why then put capital at risk? If you don't know what you don't know, if you can't quantify,
because statistically the world ends once. They always make a deal. AI is real. The U.S. consumer is intact.
That has always been.
The job market is intact. True, blah blah blah. I mean,
that has always been true. That has always been true.
So that's why
that has not prevented the markets from going down on growth concerns, which is the real sort of thing here. If you look again, what happened between mid-February, let's call it, to mid-March, discounting the fact that stock markets stopped rising in early December and haven't revisited those highs since. But let's say we just take the down move from mid-February, let's call it, second half of February to mid-March. The concern wasn't some sort of Armageddon meltdown. It was recession, regular recession. Not anything crazy, not anything outside the norm, just the regular ebb and flow of the business cycle. I don't think we need to be constantly looking for another 08 or another COVID. I mean, maybe, and of course, what makes this different from 2022 is in 2022, everybody had giant Olympic pools worth of cheap zero-cost liquidity with years to refinance it, and the refinancing begins in earnest this year and next. So we'll see what kind of a crisis this is when growth falls out the bottom and GDP or debt to GDP ratios move higher because the GDP part of the ratio gets worse and the debt part gets at best no worse, but probably even worse still because all these firings at Doge don't really change anything and a lot of them are being undone. Meanwhile, these tax cuts are probably coming in some version. So all of this we'll see. But set all that aside. No credit crisis. Set that aside. just a regular recession. I mean, that much seems to be here. And the markets seem to be getting a Fed that says, we know and we're not going to help you until we really see you keeling over in pain. We'd like to see you squirm more before the Novocaine is made available. That does not seem like a positive recipe for risk taking. Just in terms of, do you want to lay out capital or don't you? Near term, not sort of structurally over 10 years. All of that, I think, makes perfect sense. The trajectory isn't negative by any stretch of the imagination if you pull back to like a 10-year view. Even a 5-year view, maybe. But 6-month view? I don't know that anybody should be particularly enthusiastic about wanting to take cyclical market risk here.
No, and what concerns me is that throughout the tariff headlines and through the Fed meeting today, I see a Russell 2000 that looks like it's beginning to keel over. There's this band that we traded in back in March to where we're trading right now, more or less around these levels. We'll call it wrapped around 2K, where there's been support and now there's resistance. And as we're facing this resistance, we're beginning to lose the rally that we have off the April lows. So it's not the best thing in the world. Of course, Ilya would contend that horizontal lines matter more than diagonals. And so, you know, we could meander here a little bit and lose the uptrend, but not actually have really lost the uptrend because we're just dealing with this resistance. I asked you this a few weeks ago when the tariffs went into play. Like, what's the view from Europe? What's the deal with manufacturing? Has your conversation changed at all? Are you hearing from your business contacts in the U.S. or in Europe anything different about the tariff impact and fallout? I know it's anecdata, but I think it provides certain color and perspective.
I mean, I would say the only thing that's changed is it's less and less of a topic.
It's just accepted.
Was the topic a month ago, and now it's sort of considered a de facto thing that just needs to be dealt with, and everybody sort of, it's not. I would say that it's not like there's a desire not to do business with the United States. There's obviously a strong desire to be involved in as much of an ally with the United States as possible. But it's no longer a sort of churning. It's a hope for the best and make plans for the worst, I guess, would be the theme of a month later.
It's an interesting mindset shift, right? Because it's kind of like with the VIX in a sense. Something new has arrived, you're uncertain, and then you benchmark the risk and you kind of move on. Ilya,
that's what it feels like. It's like, okay, this is what it is. Like, hopefully it's not as bad as it could. Sounds like it might be.
What's the risk that our bearish fundamental view is wrong? Is it just that you have a lot of chase in this market in the short term? People under
there's going to be deals, and that we're going to be the markets that it's not going to be that bad. It's not going to be that disruptive.
I think
the recession is going to be mild. Sure, you might get 2 quarters negative growth, but it's going to be decimals, nothing crazy.
I think for that view to prevail, because I think that's a very logical kind of thing, and the markets want to have that view. That's the real
June, no matter what.
Exactly, which they're not. I think that's the problem with that kind of view here. Is if you had a view that the Fed is going to cut, and you felt good about that, and the Fed gave you some indication that they're marking time, but that their confidence in where they're going is strong, I think the market would reason exactly as Dylan has described here. Look, we're going to get a mild recession because of this shock. Understandable. The Fed's going to cushion everybody in cheap money. That'll make this digestible. There is no knowing that this is going to be some kind of a crisis or it isn't. But why bet on one until there's a reason to bet on it, keep it going. That's perfectly logical if you have a Fed that's going to cushion you. But if the Fed doesn't know and is reluctant and feels itself hamstrung, and you in the markets have already decided what you think it's going to be, you've taken down break evens, you're pricing in speedier rate cuts as though to tell the Fed, we've made the call, guys. You need to go. And the Fed is saying, no, we don't, and we won't. And so,
and why do you think the Fed wouldn't cut rates in June?
Well, at this point, that's not even priced in.
It's actually June cut odds are lower today post-Fed than they were yesterday.
This morning, I think it was like a 1 in 3 chance. What is it now?
1 in 4. 23%,
yeah,
as opposed to 31%.
The market thinks the Fed's going to go in July and then go in July. Obviously, there's no meeting in August, but there's Jackson Hole. And then they're going to go 2 more times, probably in September and November, is what it looks like in the pricing now.
December. The meeting is, October. We have an October 29th meeting this year. No November meeting.
Oh, that's right. That's right. That's right.
But yeah,
calendar is all funky. The July futures don't even price in the cut fully. You have to go out to September because the meeting is on July 30th.
Yeah.
So for most of the month, there is no cut. But by September, it's already there and some ways on. So you can see it, but you kind of have to massage the quotes.
So the cadence would be a cut in July, a cut in September, a cut in December. There's no August meeting. There's no November meeting. So that would still be 3 by the end of the year, which is what the Fed is telling us. However, again, I'm going to pull this up here on the screen. My quip right now is that the market is getting less confident in the Fed's ability to deliver these cuts. And if they do deliver the cuts, they're not going to be necessarily for the right reason. The June trading here, a week ago, 63.2% chance of a 25 basis point rate cut in June. Now down to 23.3%. Even going out to the December contract here, we see a week ago, the market favoring 74% chance that we're getting it to at least the 325 to 350 range in the main rate. Now that's only about 37% aggregate all the way down. So fewer cuts are coming. The market's not confident the Fed's going to be able to deliver them. And the longer that we're drawn out here with uncertainty around the tariffs, the longer the Fed is stuck. The Fed wants to cut. The market knows the Fed wants to cut. They're both looking for the permission structure to cut. Has not been granted yet. Perhaps today's rescission of the chips tariffs is a step in the right direction and shows that there's flexibility and malleability and everything is a deal that can be made. Everyone has a price that can be met. That's the upside scenario. We've been talking a lot about stocks here in this macro level for the equity indexes. I suppose bonds, Ilya, Ilya and I this week were talking about how we're expecting a lot of chop, slight upside bias. This week we have some chop with some slight upside bias now. I mean, do you find yourself looking to change anything here, Ilya? I'm totally content with my ZN and ZB positions.
Yeah, I'm fine. I'm long again. I'm long via a TLT call spread. And I think what you get today kind of makes sense. Because what you have is the market saying, right, so you're not going to cut now. That probably means more easing later. And you're probably going to have to do more to catch up because we're already telling you what you have to do and you won't do it. So you're going to have to be more aggressive because you're going to be more so behind the ball. That makes sense in the context of what seems to be happening in the bond market here. I think you only get more of that as you keep going and the markets kind of digest what's just occurred. So, yeah, I'm not changing anything here.
I mean, I just feel like the stock and the bond market are the most strategic, or most, not even, they're vague. I feel like gold, oil, currencies are more.
They're all kind of in agreement, though, today. Right?
Today they are.
Today's kind of a buy America day, which is a good thing. right? It's not necessarily how I'm fully positioned in this market right now, but that's a good thing. You have the dollar up across the board against all of the majors, and they're higher now than they were before the Fed meeting. Bonds are up and hold on to their gains from the day. Gold is down, which taking a percent step back after the huge rally to start the week. So stocks up, bond up, dollar up, gold down. That's Buy America.
For sure.
That's good news. It's you're checking all the boxes for the capital flows. Today is definitely a more optimistic day on the margins. I just can't for the life of me understand why, given what Powell told us.
And I come back to the only answer is Fed's going to cut, the recession's going to be mild, and there's going to be a giant July 4th deal session that's going to we're going to be sitting here in October and we'll have forgotten the word tariff.
I would love to forget the word tariff. Unfortunately, it's the most beautiful word in the English language, so it's not going to be leaving my vocabulary anytime soon. Ilya, so let's square the circle. We can talk about the Buy America, Sell America narrative. Okay, so it's a Buy America kind of day. You look to the stock market. There's a growth hue because of the outperformance of tech. XLK, XLY, SMH, all near the top of the leaderboard. Silver, copper, oil. Taking a bath. Is today a good day or a bad day? Because the commodities, in a certain perspective, are offering you a rather dour point of view on which way things are heading right now in the market. Copper off 3.34%, silver off 2.03, silver off 2.31, and oil off 2.01%.
I mean, you have to, I think, again, look at what the bottom line is. And the bottom line is a growth scare. Stocks are not optimistic. They're just not running for the hills imminently. That doesn't necessarily tell you that anything positive has happened. I mean, they haven't even erased the 2 days of selling that they did going into this Fed meeting just on general uncertainty around what the Fed maybe could possibly say. And there was no action priced in at all with strong conviction. But when you look at what commodities are telling you, they go, wait, so we're supposed to get hopped up that the U.S. and China maybe are finally talking? Is that what we're supposed to get hopped up about? Or are we supposed to get hopped up about maybe the tariffs will only be 10% across the board, which is a 5-fold increase versus the 2% tariff that we had on average before, and pretend like that's not going to be a giant hit to economic growth? Is that what we're supposed to say? No. I mean, obviously, I think when you look at those things that are the most clearly cyclical, what you have is a very growth concern type of vibe. And moreover, I mean, look at how the currencies stack up today. I mean, yes, it is a Buy America day, kinda. The dollar is stronger, but look at where. It isn't terribly strong against the Japanese yen. It's still only just kind of retracing 3 days of selling, only about half away. I would say the most interesting bit is how weak it is against the Aussie, a growth currency, a business cycle currency, and not nearly as strong, let's say, against the euro, where it's in a range, the pound, where it's in a range. So all of this kind of has a growth negative type of vibe. And really the question for stock markets is, at what point do they rediscover that stocks too are a cyclical asset and not just a sentiment-based asset, as they seem to have had the understanding at the beginning of the year, sort of February, March? How long before you get there? And I think not very long at all. A lot of these growth assets are telling you where the wind is blowing.
The growth assets don't look too hot. I'm trying to get out of my short put spread right now in copper. The step back today isn't great, and assuming I get filled, I'm still going to be able to take it out at a profit, which is fine. Obviously, not as big of a gain as I would have liked to. The copper candlestick is what alarms me because we've talked all year long about how copper has been really, really reliable for candlestick charting. If it's been the bearish engulfing bars, key reversals that we've seen at numerous highs, or the evening star candlestick cluster at highs, or the morning star candlestick cluster at lows, it's been pretty reliable to work around. Today's move is a bearish outside engulfing bar or key reversal, failing to climb through the 1 month moving average and falling back below the 1 week. Couldn't think of something more bearish to occur right there, so I'm trying to get out of this position right now. I'm still holding my gold and silver because they've been on a good run and one day back after, the rally that we've had this week on trades that still have 50 odd days to duration. Or to expiration. I'm not panicking whatsoever. The oil move, of course, Dylan, I saw you get some flowers for this the other day. Someone said only Dylan had the foresight to fade the move lower in oil. Are you fading the move lower in oil still?
Yeah, but yes, because I'm still sort of I'm still of the belief that the tariffs are going to be create a mild recession, not a severe recession, and that economic growth and economic demand for energy is going to be higher than the price suggests.
That certainly could be.
Well, the 4-hour time frame here, Ilya, I think it's worth noting. We had a run up into 60 or so, the midpoint of basically the post-Liberation Day trading range for better or for worse, right? 65 down to 55 or so, $10 wide, $5 in the middle. We back off that here now. I could say left shoulder, head, right shoulder maybe coming together against the neckline. But then again, that would just carry you to the top side of the range. So I suppose if we're looking for new entries right now, if you're looking long, you're either buying down near 55 or waiting for a breakout through 60. This is kind of a dead zone. You could short this now back down to 55 with a stop against 60, or you could wait for a rally up into the mid 60s to get short. This is a pretty crappy spot, though, from my point of view. You might have to ride out some pain here, like I'm riding out right now with my short put spread in oil. But I'm with you guys. I think oil has come in a whole bunch, and the administration is maneuvering so that energy prices stay as low as they can without breaching the floor that puts oil production out of business in the U.S., which granted we're at that level right now. We already heard from Diamondback Energy CEO yesterday saying that they're going to have to start shuttering rigs. So perhaps the administration wants oil that's like 60 to 65 as opposed to 50 to 65, 55 to 60. I'm going to continue to trade around this like it's a meaningful, reliable floor in the short term. It sucks right now with today's move, but I think we got to treat 55 as a floor for the foreseeable future. And Dylan, I know you are.
But if you knew that July 4th, 2025 was going to be the greatest deal day in the history of America for the greatest number of deals that have ever happened for America, for trade and tariffs and whatever, would you want to own stocks now or not? Would you want to own oil now or not? Would you, like, if you knew July 4th is going to be deal-orama?
Yeah, I'd want to own stocks now. Like, would I want to own? Is it a buy and hold trade, or is it buying with an expiry?
Yeah, I don't know. I don't know. I
don't
know what my own answer to that question is, but I think that's a question worth asking.
Well, structure the trade, right?
If I thought there was a lot of announcements and good were not part of this, let's say I'm going to get deal-orama
and a Fed cut in July.
So if there's lots of deals and there's a rate cut in July, I think risk likes that. I think it's probably a temporary risk likes it because it doesn't change the economic trajectory. But I think risk would like it. I think the question of what the deals are will matter a great deal. And if it was, no pun intended. And if all of that pain and confusion ultimately gives us what we've already seen with the NAFTA to the USMCA dance, which is to say not much changed at all. The deal just got a little bit broader to include more stuff and basically made for a broader trade deal, not a narrower one. I think the markets are going to look at this and go, okay, so we're willing to sacrifice the economy for optics, and we have 3 more years of that. That's not good. That isn't an environment that's conducive to risk taking. And I think that ultimately is why whatever initial optimism you have doesn't hold. There will be initial optimism, I agree.
Yeah, I'm not even saying. I'm just saying if you take the most cynical perspective on all of this, which is this is really about Donald Trump getting building permits in Hanoi or whatever, sure, personal interest this is about.
Sure.
And that ultimately this is all going to be washed away after he's collected whatever fees and tolls and whatever money he's trying to gather.
Once the tithe is paid, yes.
Yeah, once he's sort of collected his piece of whatever, from every deal, which I think there's a reasonable chance that's what's going on here.
Yeah. So Dylan, I'm going to put some meat on that bone for a quick second. The chip curve, as I'm reading into it right now, is about something called the AI diffusion rule. Now, the diffusion of this technology, as it addresses, this is not a rescission that impacts China. No, it impacts the UAE and Saudi Arabia specifically. Dylan, where is the president traveling to next week?
I believe Saudi Arabia and the United Arab Emirates.
So fluffing the landing, if you will, right? Fluffing the landing is not an
expression. Look what I can do for you if I want to.
But also, fluffing the landing has hereby been christened as a great pronouncement for all time.
Yeah, saying
hear ye, hear ye.
I'm
White smoke.
I'm having a great linguistic week here on Overtime.
That's true. But I'm just saying, if you set aside whatever your opinion is of whatever that is, I'm just saying at the end of the day, the markets, I feel like the reason the stock chart looks the way it does is because the stock market decided that that's what's going on, which means that these deals are not, that the tariffs are of limited duration and relevance.
Yeah, I mean, I guess short term, we probably get a little bit more craziness. But Dylan, if we want to embrace the YOLO madman trade type of view, 72 days out, July 18th expiry, pretty good day. 6,000 long, short 6,200, probability of profit 28%, risk 1 to make 4. And in Tesla, similar story, right? Risking $90 to make 2,400. Decent risk to reward if we get a break out of the range. And if Tesla's going up to 370, 380, S&P's probably looking at another big swing to the upside. So the technicals
so that's
are
your
saying,
Dealerama madman trade.
I'm going to flip. And listen, if we start poking through 57.73 on ES, I'm willing to risk 150 points.
Yeah.
To say I'm wrong. And if we get down below 5,500, I will cut the short, and then I'll think about looking long again.
I'm in much the same boat. If the trade is wrong, it's wrong. I'm not by any means committed to being short stocks just for fun or for some sort of period. Well, I mean, I'm long stocks in Brazil as of this week, so I'm not uniformly short everything everywhere.
Dylan, this guy will just not buy American stocks. Can't convince him. He can't sell him a SPY or a triple Q.
But you're buying Brazil?
Yeah, you gotta.
But you're gonna buy Brazil, but you won't buy oil.
Somebody I remember saying you gotta buy low and sell high.
I mean, buying Brazil, you might as well just buy crude oil. What do you get? It's just a Petrobras proxy.
Oh no, I think it's a soy proxy. Okay. I think the talks with China aren't going to go like how they went last time, where they say, well, we'll just buy more soy, and then they don't. And the next biggest producer is Brazil. Also, I don't think things can get much worse in Brazil. They seem to have gotten about as bad as you could possibly imagine. And we're starting to see maybe some turning. So I bought a 240-day call that I'm just going to tuck into the inventory, and I'll see you in December for how it went. But I'm not by any means opposed to finding equity market value. If the market decides that it doesn't want to sell on this, so be it.
Well, we'll be back tomorrow to discuss all of this because overtime is now out of time for this Wednesday, May 7th. A happy Fed Day to everyone who celebrates. We're going to take a quick break here on Tasty Live. Ilya Spivak's going to be back with Macro Money in a few minutes, so we're on our way out the door. For Ilya Spivak, Dylan Radigan, I've been Chris Vecchio. Good luck trading. See you on a little bit.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Zach, South Carolina, how are you, my friend?
Hey, I'm good, guys. I just wanted to let you guys know and Tasty Nation know that I've been following you guys for 3 years. Where else can you call two real traders? They pick up the phone and answer your question. There's so many so-called traders out there that give you vague strategies and want you to buy their course to learn more, but you guys at Tasty put all your info out for free, and all you ask in return is for us to use your platform. Thanks as always for what you guys do.
Love it, man. Thanks. Thank you, man. Thank you. I really appreciate it. Very kind word.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new Tasty Trade and Tasty Live web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Well, we've had a Fed policy announcement. It did stuff. Markets wiggled this way and wiggled that way, but ultimately no change in policy. And what I've been describing as strategic vagueness in the messaging, we'll get into that in just a moment. And of course, the big question for markets as ever, what's next after all of this and what does it mean? That's what we're going to tackle here on Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live, and we're just going to jump right into it. We'll unpack what the Fed did and said here, which was not much, but perhaps that is a message unto itself, and then take a look at another central bank that is waiting in the wings here to rattle markets in just a matter of hours. So first up, of course, just to look at the S&P 500 here in the wake of this Fed policy announcement. We can see from the price action, the markets were somewhat heartened, having been on the downside going into this meeting Monday and Tuesday, pulling back from this barrier here around 57.24, this kind of inflection point right here. And very tellingly, as we discussed on the show yesterday, also the spot right before that Liberation Day gap that gave us all of the consternation that was the month of April. So we've reset all the way, and we're back to where we landed when growth concerns about the U.S. economy started to take this market down from about mid to late February into mid-March. We paused to digest. Of course, then we had the scare. We're off the scare and back to where we paused to digest. And so the question is that of growth, and the Fed seemingly telling markets today that it doesn't know what to do next because it doesn't know whether to prioritize growth or inflation, and that rates are well positioned to act either way when that clarity emerges. When it will emerge, who knows? And the uncertainty means that they're not going to do much of anything for now. The markets cautiously off toward their lows for the session once the announcement hits, then back up because they don't find enough conviction to make lasting progress. However, when you look at the bond market, what you do see is a little bit of a pull up here at the long end, ostensibly around this idea that if the Fed is going to delay rate cuts now, it'll have to cut more later. So you get a little bit lower yields and higher bonds at the long end of the curve. The U.S. dollar here doing next to nothing. This is the dollar index, and it is firmly confined within a range. The dollar a little bit higher against assorted currencies, but not really going very far at all. Basically stuck within the ranges where it has been oscillating recently. There's a little bit more vigor on the yen, perhaps a little bit less on the Australian dollar, and really as you look across markets, you end up with the kind of goose egg of a response that we're seeing right here. So just a touch higher, but ultimately going no place far. Here's the Fed's statement and the changes in the communication. We, of course, noted the impacts of trade in distorting GDP data, and the Fed leads with that here. Just to quickly give a sense, here is that distortion. Obviously, we can see a giant jump in imports and then a surge in investment around building inventories, all of that, the front running of tariffs. And the Fed very clearly name checks that right from the get-go, says that uncertainty about the economic outlook has increased further, ostensibly since March. And the Fed judges that the risks of higher unemployment and higher inflation have risen. In other words, risks pushing the Fed's objectives in opposite directions have risen. And this, of course, lines up exactly with what the Fed gave us in March, the last time it updated its economic growth expectations. We can see they went from from faster growth to slower, from lower inflation to higher. Didn't change anything on rates, though, basically reasoning we don't know which way to jump. Our objectives are at odds. There's no imminent reason for us to jump necessarily. We're going to wait and see. And that's basically what today's rate decision boils down to. If we can see here the expected rates path going forward, we have one cut at minimum on the board by September. It is almost certainly at this point slated for July, but doesn't appear in July in the quote because of technical reasons. The meeting is on July 30th. So indeed, for most of the month of July, there is no cut. But by the time you get to September, of course, that cut is already priced in, and there's no meeting in August. So in July, there is a cut. We further see cuts in October, again, going into November. That's a very late meeting, and then in December as well. So we end up with 3 cuts essentially, on the board here, starting in the second half of the year. That much has not changed very much here. The path has become a little bit actually stickier at the front end of this year's curve as relative to March and January. We can see the Fed is actually expected to hold off on cutting a little bit longer. There was a much smoother glide path here, and that glide path favored actually higher rates but sooner cuts as the year progresses. And here we're looking for a longer delay, but then a faster decline into a lower level. And that's, of course, exactly what the rise at the long end seems to kind of echo, this idea that there will be a delay, and while this dithering means rates will be held higher longer, it also means that they will be cut sharper later. You see in the outlook also sort of where this kind of hard neutral stance from the Fed ends up as a kind of inflating of the outlook for next year, if only modestly. We've added about 9 basis points from yesterday to today into the cumulative cutting cycle from this year through the end of 2026. We can see that wiggle in the orange cumulative line here. We also see that the Fed is holding to this hard neutral stance, and that of course implies, as we can see from here, 50 basis points apiece this year and next. So from this 4.4 here down to 3.9, that's 50 basis points, then down to 3.4, that's 100 basis points. The markets are, again, a little bit to the dovish side of that now after the policy announcement. Moreover, they don't want 2 cuts this year, they want 3, with at least 1 more in 2026. And that, of course, is a little bit more dovish. So on balance, this announcement is a bit to the dovish side for markets, because they ostensibly expect more to need to be done later. But as far as sort of where the Fed is positioned, although there isn't much delta in between where the markets are at 109 basis points and where the Fed is at 100, the markets wanted this to happen faster. And so there is perhaps some level of disappointment here, although we can see from the reaction in the S&P that disappointment is mild at best, at least so far. Now, from the Fed's perspective, they're saying we just don't know what to do with inflation expectations. And to that end, we can see that although core inflation started to slow in the most recent set of numbers in March, we also only have about 1 month's worth of cooling in these higher frequency 3-month and 6-month annualized rates. Recall that at the beginning of last year, this is a similar thing that was happening, and the Fed resisted rate cuts that the markets were calling for from about April all the way until September. So it had to see all of this cool down from this pop in inflation dynamics, and we're very early into something like that. So the on-ramp here for rate cuts looking relatively long. And interestingly enough, the markets seem to have called already for what is likely to be needed at this point. We can see here, this is inflation expectations priced into bond markets. They're suggesting that inflation is going to end up lower, not higher, downwind. And that's because whatever economic downturn comes as a consequence of the tariffs will so thoroughly pummel demand that any one-off price increase from the consumption tax that is a tariff, which just an extra sales tax on particularly imported goods, what price increase then will come from that will be more than overwhelmed and more than subsumed in disinflationary pressure from the recession that those tariffs cause. And so with that in mind, the market is already saying to the Fed, look, you don't have to worry about inflation expectations. You can just cut. And we want 3 cuts, and we want them to start sooner. Let's go. And what the Fed is saying is, yeah, we are not going to make that call here, especially given the political pressure that we're under and given the sort of uneven nature of the data. We can, and Powell said this repeatedly today, along with the markets, see very clearly that the survey data is awful. We can see in the PMIs, growth has stalled to near standstill, whether you look at S&P Global, where it's a little bit better on manufacturing data, a little bit worse on services, or ISM, where it's a little bit better on services, a little bit worse on manufacturing. Either way, the midline here falls a touch above the midpoint of 50, meaning the economy has gone to basically standstill mode, just a touch better. We've already seen the distortion in GDP. It was a negative number, but all of this fuzz here obscures it. We saw a slightly better than expected NFP number, but the 47K by which this outperformed is almost completely undone by the 48K downward by which the prior month's numbers were revised. So there's not a clear read from the hard data here as far as the Fed is concerned for them to unequivocally and beyond reproach justify rate cuts, even though the market is already screaming at them that the time has come. And for this reason, the drill down bottom line here may well be disappointing for stocks, because all of what they are seeing in the survey data, they've already made up their mind about. But the Fed isn't giving them the hopeful sheen of future rate cuts to feel like they can weather what may well be a sort of garden variety mild recession. And with the fog so thick, they may well opt to back away from risk taking. But that is certainly not how this has played out so far, at least in the immediate aftermath. And this is where things get especially interesting, because we get a very different kind of view, but on all of the same dynamics across the Atlantic from the Bank of England. Now here, we are fully expecting that we are going to see a cut from 4.5% to 4.25% fully baked in. And we can see that, moreover, there's further easing here expected. In fact, for the year, we're looking at almost a full 100 basis points baked in. We can see from 4.5 to essentially 3.5, the 3 basis point round off there, but that's not really anything to quibble at. The chances here are exceedingly high. So you get from 4.5 to 4.25 here. That's one cut. By August, you already have a second. By November, you've already had a third. And by December, you've almost certainly had a fourth. So a very kind of clearly negative path for rates, and a view that has become increasingly dovish since the beginning of the year. The view for February and March, we can see here, was a little bit better. In fact, we'd actually seen a little bit of a hawkish shift from February into March, but obviously that has since fallen away. Looking beyond this week, we can see the markets pricing in 84 basis points in further easing. So again, leaning to 3 more cuts this year after this one, and then about a 50-50 shot at a 5th cut next year. Now, this, of course, lines up with terrible economic data recently out of the UK. We can see the economy has actually moved into contraction mode. And although it had been hovering near standstill basically since the end of last year, what we see is that now, while manufacturing has been anemic, services was holding it up. And as with most developed economies, services is a bigger piece of the pie. So despite the fact that manufacturing has been shrinking now for 7 consecutive months. That would be readings sub 50 in the logic of PMIs. It is nevertheless being or was being offset by services over the preceding 6 months, and over this last 7th one in the sequence in April, services actually fell below that 50 level as well to 49, and so we now have contraction across the whole of the economy, and we're back into sort of recessionary-like conditions in the UK. On the inflation side of things, things are looking like things are beginning to cool off again. We can see headline inflation coming down to 2.6%. That's a significant improvement here over recent data. The last time that we were at 2.6% was back in November of last year. So this is a 4-month low on headline inflation. The number for core down to 3.4%. That's the lowest since December of last year. So a little bit of an unwinding here, but actually the internals of the numbers making them look more supportive still, because you're seeing a broadening of disinflation. So these categories, of course, were already relatively low. Clothing, barely a rounding error, where inflation got slightly positive from a slightly negative contribution. But the biggest items on the board here, recreation and hospitality. These have been sticky parts of the inflation puzzle for the UK for a long time. And what we've seen here now is they're finally showing some real disinflationary vigor, suggesting that maybe, perhaps, UK inflation is finally unclenching and is going to give the Bank of England what it needs to cut with all of the aggression that is being implied right here. But this then is the key. If with the Fed we are waiting for hard data to get the Fed to start moving, and the markets want the Fed to start moving, and are screaming at it that it needs to have more urgency, well, then there seems to be plenty of urgency for the Bank of England. We know why they want to cut. We know that the markets think they're going to cut a bunch more. We have all the evidence that we need. And that's before we take into account all of the most recent activity around tariffs, around sort of evidence that the U.S. is slowing, and the idea that without the U.S., anemic Europe and anemic China, the other two major engines of global growth, really don't have what it takes to hold back a global recession. If the U.S. slows, then global growth doesn't have much of a leg to stand on. So there's lots more economic negativity than just sort of the idiosyncratic issues in the UK. No doubt the Bank of England will have to wrestle with them. But with all of the evidence already on the table, there may not be anything else for them to pull out of their bag to mollify markets. They are already expected to cut 4 times this year. The data is already signaling as much, and the markets agree. So there isn't much else that the Bank of England can signal that it needs or can justify doing. And so, although on one hand, you have the Fed saying, we don't have what we need to do more, so we're going to do nothing, the Bank of England is lining up to say, we're about set to do everything that we're going to do, and there's nothing new or more supportive that we're going to tell you. And so while one central bank is very much intent on action, and the other one apparently is not. The upshot from both seems to be global growth is slowing, and there is nothing extra beyond what is already priced in that we're going to do about it now. And of course, with no great help coming from the fiscal side, really anywhere one might look, perhaps maybe the situation in the Eurozone gets a little bit peppier from that perspective, and by extension in the UK, as more spending on defense is done amid concerns around the viability of all of the NATO allies and their willingness to come to each other's aid. Certainly a lot more questions around just how reliable the U.S. security blanket is in the current environment. So maybe that spending, as has been expected, really gives a big push to European growth next year. But with German Chancellor Friedrich Merz barely getting through procedural hurdles to take his post, there is perhaps a harder slog in that direction, or at least the appearance of one here near term. And for now, it looks like what we have is impenetrably anemic European growth. China, that just rounded off its 8th consecutive quarter of economy-wide deflation and hasn't really grown since before we had a reopening from COVID. It's grown in sort of basic terms, but the economy hasn't gone anywhere. Demand is receding. The kind of growth that China needs to push the economy forward as opposed to backslide is nowhere on the menu. And the U.S. really was the only game in town. With the U.S. now, at least looking at the survey data, edging to standstill, and the one bit of these GDP numbers that's sort of the most clear-cut is the weakest household consumption in almost 2 years, going back to the second quarter of 2023. That, of course, is close to 70% of GDP. And all of this fuzz aside, this is the part that matters. This is where GDP is really decided. All of that suggesting the U.S. economy is slowing, and thereby the globe facing a significant recession risk altogether and all at the same time. The upshot from yet another central bank is, well, we're not going to give you any more. There is nothing else to give you. We've done all that we are prepared to commit to doing, or at least we've laid out all that we're prepared to commit to doing. And that's the message from both of these central banks. And the upshot, then, is anything but encouraging for stock markets, which want for there to be stimulus to make them believe that they can weather the near-term downturn. Probably supportive for bonds, where inaction now and an unwillingness to dial it up now across central banks probably means lower interest rates downwind, because more rate cuts have to come, and with greater vigor once the pain really starts to be indisputable. That is Macro Money for today. As ever, we are here right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go from there. I am likewise on with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones on Tuesdays for The Price of Truth. Chris, incidentally, will be there today in just 30 minutes time, so check that out for a deep discussion of what the Fed means and where the puck is sailing from here. I'm likewise on with Victor for First Call alongside Tom on Sundays, writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.
Tom, when you talk about the good guys, who are they?
They are us. We are the good guys.
When you say they take out the weekend, what does that mean to you?
That means when you're a premium seller and they take out the weekend, that means that all the decay over those 2 days, Saturday and Sunday when the markets are closed, come out of the market Monday morning.
When I say bell to bell, what does that mean to you?
Bell to bell is like, in horse racing they would call it wire to wire, and in trading they call it bell to bell. So the opening bell to the closing bell.
If you're saying something's thin, what does that mean to you?
That means it's not very liquid. That means that the marketplace is relatively illiquid. That's what thin means.
If you can't buy an uptick, what's happening?
If you can't buy an uptick, that means the market is going down and there's no bounce.
How does Daddy do it?
Daddy does it good.
All right, we're back. Tasty Crypto Show. I'm Ryan Grace. With me today, of course, Katie McGarrigle. Katie, welcome back.
Thank you.
I know you couldn't wait to get back in here after the weekend, and here we are.
Knocking down the door.
Yeah.
Kind of.
How was your weekend?
It's good. What did I do? Didn't do a whole lot. My dad was in town dog sitting.
Nice.
Spent a little bit of time with him. Took him to Aberdeen. He's a big fan of Aberdeen Tap.
So am I.
Yep.
So am I.
Yeah, it's a great spot for anybody that's in the Chicago area. Good food. I like their Southwest chicken wrap.
Great chicken wings as well.
Good wings. So I saw him. Watched The Last of Us. Had the normal Sunday scaries.
Okay.
As one gets.
Just general anxiety or alcohol-induced anxiety?
Just general anxiety.
Okay, yeah.
So if anybody has any, ways to prevent Sunday scaries, sound off in the chat.
Yeah, what's up, chat?
What up, chat?
If you're not in the chat, go over to YouTube, Tasty Live's channel, to be exact, and type something crazy in there.
Yeah.
Gregor, V-Dub, Katie, I just ordered your book.
I don't have a book. So maybe Julia?
Julia has a book.
The smarter brunette at Tasty Trade. It's definitely Julia.
Oh, don't sell yourself short. If you wrote a book, people would buy it too. Yeah.
Thanks.
Yeah.
I don't know what I'd write it about, but I'll have to workshop that in my free time. What did you get into this weekend?
I didn't do anything.
That's the move sometimes.
Yeah.
Especially when it's crappy out.
Cleaned my place.
I did a little of that on Saturday as well.
Yeah, exciting stuff.
Yeah.
Yeah.
Nothing.
Did you trade any crypto this weekend, Katie?
I did not. I offloaded a little bit with what we kind of saw last week, like a little bit more strength coming into Bitcoin. I offloaded a teeny tiny bit of my Bitcoin position, but.
See, I thought when you use the term offload, to me, you have like a container ship sized position, and you're offloading.
No, it was more like I just took some pennies, like beep beep beep.
Okay.
More like that.
Okay.
Did
it's like a little profit up there around 97 or so.
Yeah.
Nice trade.
Thanks. What did you do?
I didn't trade anything over the weekend. I bought a little bit of ETH when it pushed underneath 1,800 earlier today. I just keep throwing good money after bad. We'll talk about that in just a second, but didn't really trade over the weekend, though I have been more focused recently on BitTensor. TAO, Tau is the symbol. It's not on the Tasty Trade platform yet, but we're going to work on adding to that list of tokens. So I traded a little bit in there over the weekend, but no, I haven't done too much here, though we've been chopping around.
Yeah, I mean, and to your point, like there's just been a lot of new ads to the crypto offering at Tasty Trade over the last couple of months. And I don't think you guys have any plans of stopping, so.
No, we're hoping to add another 4 tokens this week and then continuing to expand that list. So you can see the new list up here. Previously, you go back just a few months ago, there were only 4 tokens that are available to trade. That was Bitcoin, Bitcoin Cash, Litecoin, and Ethereum. We've added Doge. We've added Solana, XRP, SWI. I could keep going, but I won't.
XRP is having a moment.
It is. It is. When you look at some of our data, it's become a lot more popular recently. You've certainly followed it in the news. I think we talked about that to some extent with Hidden Road, with what they're trying to do with their stablecoin and trying to bring all these institutions to their ecosystem. Certainly benefiting from that. But one of the tokens that you can trade now through Tasty Trade, through Zero Hash, you can see the list right up here on the screen. And if you don't have crypto trading enabled, you want to trade it in your Tasty Trade brokerage account, really trade everything in one place. That's what I like about it personally.
Yeah.
You've got crypto, you've got stocks, options, futures, whatever else is coming down the
options.
pipeline. Futures options.
I feel like you're the crypto champion of the firm, and I'm like the futures options champion of the firm.
Oh yeah. I haven't traded any futures options in a while, though. I did come in. I came in long some gold today, so I'm patting myself on the back there.
Okay, I've got a free butterfly in there right now, and I've been short perpetually for probably 18 months. So
you can always flip it over and go long.
Well, as soon as I do, we're collapsing. So maybe
you let me know when you're ready. Okay, yeah.
Yeah.
I'll be unloading, offloading.
I will be the reverse indicator.
But yeah, if you want to trade this alongside everything else at Tasty Trade, you just have to enable crypto trading on your account. You can do that within the settings section here. So you log into your account, or you can do that on the platform if you don't have it enabled. Cash or margin accounts, individual accounts, you'll see that button. Just quickly click that. It'll take you to the page, and then you'll be able to get started trading crypto if you want to.
Yep. Sounds great. So yeah, that's all I did. Very curious to kind of hear what your thoughts are, especially since, I think our last couple of conversations, we've been towards the lower end of the range. And then last week, we obviously, as you mentioned, kind of started to nibble in those like upper 90s again in Bitcoin. So where is your head at?
Yeah, let's jump into the slides here. Let's talk about what's moving, Katie.
What is moving? That is like an unflattering picture of me. Like, I look like a thumb, just saying. But what happened to the photos that we took? We took some updated ones. We need to get those into rotation.
Yeah, we do. We need to reload here. I appear a bit confused, per usual. Let's talk about what's moving. Here's our performance dashboard. I updated this in the morning. We're not too far off of these spot prices. I've got Bitcoin on the Tasty platform right now at 94.5, 94.1, chopping around here today. I guess my takeaway recently has been to stick with what's working.
Sure.
So you'll see here, and this has been the case for a few weeks now, if not the last month really, Bitcoin's been resilient. It's not the same as most altcoins. It's not to say that there aren't opportunities in those, but Bitcoin is in its own category. And you quite often see that reflected in its performance. That's what's been apparent recently. So you look at the price momentum, it's been bullish in there. The volatility didn't explode when you saw risk assets really jump off a cliff earlier in the month. And so while I'm tempted at times to try to buy dips, I told you how I'm throwing good money after bad, seemingly, in ETH, and I'm finding other opportunities at times for trades. I think when I look at that long term, kind of buy the dip, this is an environment in which, I want to be long Bitcoin, probably leaning a little bit more heavily on that than I am in something like, memes or even Solana at this point. Translated, trading that implied volatility, one standard deviation, everything here is telling me that, I still want to be in Bitcoin market cap dominance over everything else. We haven't seen that rotation into other tokens, which I think you will see, but it's probably after we've seen Bitcoin go up a bit more here.
Yeah, makes total sense. And I feel like, to your point, like there's starting to be more chatter around like regulatory clarity and like what plans kind of look like. So maybe we'll kind of continue to see some of that, as you said.
Yeah, volatility has come in here quite a bit. So that's one thing I'll point out, that the IV rank for Bitcoin is basically at 0.
Yeah.
ETH is low as well. And then realized volatilities, because we don't have options markets that we trade for Solana, for XRP, or others. So we go off of a 30-day realized volatility. We annualize that vol. And we've come down back into the 70s, kind of mid-80s for some of these tokens. That's relevant. It might look high, but it's low versus the 120% or 200% that we've seen some of these trade at times. So not necessarily trying to caution anyone. Just be aware that some of these moves that you're seeing are pretty low. Volatility is pretty low in there versus what they can do. It doesn't mean that they will do that, but moving, 1% or 0.5%, 1% to 2% per day is a pretty small move versus what we've seen.
Yeah. It's just so interesting, like, when you say that, because when I'm on the show with Mike and Nick, as you often are as well, weren't you on today?
I was, yeah.
Like, if I'm ever presenting a currency trade, and then I go and I'm saying, yeah, I'm seeing, I want like a little bit of a pullback in the euro or something like that. And then I have to go and tell people, and I like look at the implied volatilities on the platform, and they are always like single digits, if not very low, like teens, more or less. It's just wild that, I guess it's all relative to your point. Like,
this is on that other end of the spectrum.
Exactly. Like where I'm like, 15 is like really high implied vol for the euro,
Which it is. I mean, for a currency, right, that is extremely high volatility.
Right. But 70 is just like, it's not yawning activity for Bitcoin and some of these other coins, but it's low relative to, like what you said, 100, 200 realized vol.
Absolutely. Yeah. So just be aware that they can explode higher in volatility terms, not that they necessarily will. That said, quite often, you see those volatility explosions or the expansion there when you get that big up move. That's how we get that plus 200% volatility, because these things are screaming higher, or they can at times. So that's a quick look at our performance dashboard, wrapped around 94,000 here, a little bit of a pullback. This is what I think people should pay attention to. That trend in there, the 3-month price performance has still been deeply negative for most tokens outside of Bitcoin. Bitcoin down 7% in the last 3 months. Year to date, though, flat. But everything else versus Bitcoin has just really underperformed. That's what I mean, again, by for now, and this will change. It could change as early as this week. But for now, I'm mostly focused on trading Bitcoin.
So what do you, go back and what do you think the catalysts will be for some of that rotation?
Partially, it'll just be price across the space. I think when you see people make money, let's say the gateway is Bitcoin, or you've seen big fund flows into those ETFs. Once you get to a certain point, people are going to look for a relative outperformance in other areas, or look for those laggards like you do in the markets, in any other capacity. So I think, let's just arbitrarily throw out some numbers. Let's say Bitcoin runs from 95 here, and if we think that this is at $100,000, it's a 50% realized volatility. Annualized, that's 150 to 50 is your one standard deviation range. Big move, but let's say it pushes up towards 150. At some point, I think that people are going to look for other opportunities. And it's not to say that you won't see other tokens run in the meantime, but if you don't see that resulting performance in ETH, in Solana, I think eventually people just say, okay, wait, is this going to play catch up here? There might be a reason to take some profits over here and then get into any one of these tokens that is going to have a much smaller market cap, given the idea is that they're all positively correlated.
Right.
Maybe there's an environment in which Bitcoin completely detaches from the performance of the rest of the market. I don't think that's something we're going to see. Still very, very small in the grand scheme of things when you think about the size of the asset class. We just recently got back to $3 trillion. We've been higher before, but it's just not that big when you think about the size of gold or the commodity markets, for example. And so I think there's still room for others to run, even if Bitcoin does march higher. I don't necessarily think, and could be proven wrong here, but there's a world in which you see, Bitcoin go to 200,000 and ETH is stuck at 2,000, or Solana stuck at 200. Maybe Bitcoin market cap dominance would be at almost all-time highs. I don't think that's the case. So I think you could see a little bit of that. And then I just think you need, a macro environment that's a bit more conducive to capital flowing into these highly volatile assets.
Yeah, that's what I was going to ask you, because I was looking at information from like the SIBO today. I get their reports from time to time, and they talked a lot about, the explosion in zero-day options, which is no shock to anybody that's been in the markets for the last 5-6 years since they've gone live. But one of the things that they called out is obviously with the volatility we've seen in April, there's been a pullback in retail investor trading of them, of course. So when you say we just got back to $3 trillion in Bitcoin, is that due to what we kind of saw in April?
So this came off of, I don't know exactly what I can go and look at. So not just with Bitcoin, but you look at the whole space. What's the total market cap of crypto assets? And I might be able to pull that up really
I guess that's the better question is, with the volatility we've seen across the market as a whole, did people dial back in April?
Oh, absolutely.
Yeah.
Yeah. I mean, you saw, a pullback in some of these tokens where maybe not so much just in April, but really where this started to materialize was in February, beginning of February. You saw a lot of this start to sell off. You had monster moves in ETH, for example. You're still down, what do we have up here on the screen? Still down year to date. In ETH, 47%, down 37% in the last 3 months. So this happened before April. It was fuel on the fire there. But yeah, we saw some meme coins, AI agents, other areas of the market draw down 60, 70, 80% in some cases.
Right.
Bitcoin had a 30% pullback, which is quite normal, I guess. When you look at this historically within bull markets, what are the corrections you should come to expect? Well, those corrections are 100% within the realm of 20 to 30% down. That happens quite frequently. We just got that. It's encouraging that the price action is, trading in a little bit more bullish fashion here, back up to 94, 95. But you absolutely saw, what happened in other markets spill over into crypto.
Right.
So I think you need to get to a point, again, where, okay, what pushes Bitcoin to that higher level, and then what pushes people further out on the risk curve? It's probably, a bit more certainty around trade with the tariff situation. So we have a bit of a pause, and some things were kind of walked back from the beginning of April. I think you need some clarity out of the Federal Reserve. Right now, they apparently are on hold. And you need some clarity out of the economic data as well. We've come out of just recently reports where you can see that slowing in GDP. You can see a little bit of that slowdown, and certainly in inflation as well. That was starting to get priced into the markets, which are going to front run this data. That was starting to get priced in back in February, in March. And so we need to get out of that environment, one that's more conducive to taking risk, one in which the Mag 7 and tech stocks do well. I think crypto will do well. But in the meantime, lower interest rates and the weaker dollar are certainly presenting a decent setup for Bitcoin.
Sure. Yeah. Fair enough. What else is on your mind? Anything are you knowing that, is there anything that you would think about in, some of the corresponding ETFs, or do you want to talk through some of these other coins?
Yeah, I guess a couple things that stand out to me. I mean, it's hard to ignore SWI's performance recently, up 52% in the last month or so, on a relative basis here versus Bitcoin, up 41%. So there have been some recent pockets of outperformance over the last month. I still think, you're kind of going to go into this overweight BTC, but this is on my mind, SWI. I think you're going to see, or, you're starting to see some signs of the reemergence of that AI narrative, the coupling of AI and blockchain technology, your decentralized intelligence. So I mentioned Tau earlier, a couple other tokens that are on my radar. Render, this is one that you can get through the Tasty Crypto wallet. I also think that things like Virtuals token, some of these agent platforms, you go back to AI16Z,
right.
You're kind of seeing signs that a lot of these have probably bottomed. Doesn't mean that they're just going to launch higher, but you're seeing some growth spurts there. So that's another area of the market that I've been paying attention to. But yeah, it's really just trying to trade, some of the pullbacks in Bitcoin and the other tokens, but being aware of where that's going to go, or could go, I should say. So here's your one standard deviation moves on the weekly.
Yeah. Okay. So we've got 88,000 as the low, more or less, in Bitcoin, and 100K back on the high end of the range. Okay, nice. And then you said you layered into some ETH when it was under 1,800 today? Yeah,
I couldn't help myself. I just bought a little bit for a second. But yeah, that's one where you just haven't really seen that stair step higher in the expected move. You haven't seen the same trading in terms of price action that you've seen in Bitcoin, where what we've seen in Bitcoin is that implied volatility move The volatility has come in a little bit, so you have a smaller move, but it's implied a range of higher lows and higher highs throughout that process, where ETH, Solana, and others have really just been stuck chopping sideways. And I think you're going to see that chop continue for some time until, again, you get more of an awareness of the liquidity situation, of what monetary policy looks like going forward. And it doesn't necessarily have to come out of the U.S. It's just that there's a lot of uncertainty right now that I think is holding back new money from participating in some of these different tokens.
Sure. But, something that I think is interesting that, again, I've talked about with you when we've done the show before is the idea that, like, especially if you have like the trader mentality, it can be, I should say, different if you are going and looking through the investment like lens. So knowing if you're saying, yeah, sure, maybe there's more chop sideways, but if you have a longer term assumption that ETH or Solana or some other, coin that is listed might ultimately, bounce, why not? Like, nibble on $100 or a couple, whatever your size is, so to speak.
Yeah, I mean, I think when you look around the market, there's decent evidence that a lot of these have probably put in the bottom. It doesn't mean that you won't revisit near that low. We'll see if this is true for equities or not. They're trading a bit better as well recently from that momentum perspective. But I think there's decent signs, ample evidence that, with Bitcoin, I keep wanting to use that with crypto interchangeably, but with Bitcoin specifically, low being in there about 74, 75. The same thing with ETH, with Solana. It doesn't mean that they go straight up, but I think you probably have seen the worst of it. Anything going forward is likely going to be liquidity positive, Fed lowering rates, possibly monetizing. We'll see how that all plays out. All of these things on the margin should be positive for crypto. Mm-hmm. And I think, again, we've gotten out of kind of the worst of the tariff situation that drove volatility to those kind of extreme levels.
Yeah. So when you're doing and nibbling on your like crypto positions or like looking to like layer in a little bit more, are you, and knowing like you said that this one's kind of not necessarily been working out, are you putting it in as like all one transaction, $1 amount? Do you try to like layer in like with a couple of different prices? Like,
I'll try to dollar cost average in. Absolutely.
Okay.
Yeah, it's not like I'm sitting there and saying, okay, I've got $1,000 here that I'm going to put into a trade, or 10,000, or whatever your arbitrary value or amount is. I'm going to look at, okay, I want to be long this because the trend is bullish. This is the implied range, and I want to buy dips in that range. Knowing that it's not static, it's going to move around. It's possible that I never get to the bottom of the range, but maybe if the Bitcoin range is 88 to 100, I'm feeling a lot better given the momentum is positive in there or bullish. I might buy 90, 92, 93. But it's not firing everything you've got in one shot. It's knowing that, okay, now I have $1,000 that I want to allocate to this. Maybe I do it in tranches of $250.
Yeah.
But you're just dollar cost averaging in.
Sure. Makes sense. I've also noticed that, and we've talked about this a little bit, but more so probably Mike and Nick than you and I, but you're back on the follow page.
Yes, but I can't get it to work, so I haven't been able to post anything. So we're going to work out a technical bug. I'm not sure what's going on, but I am back on the follow page. Thanks for the shout out there, Katie.
Yeah, no, I just wanted to call it out, and maybe apology. Maybe I front ran it while we were trying to troubleshoot you.
No. I tried to post something the other day and didn't work.
Well, we'll get a little loud.
I forgot about that. Yeah, right.
But I think it'll be helpful to see that, like, especially when you look in the chat and people are just talking about certain coins or have questions or anything like that. So drop your questions in the chat anytime you all want. But I'm looking forward to kind of seeing how you navigate both the crypto space as well as some of the ETFs, just the equity markets as a whole. So looking forward to having you.
Yeah, I mean, look, at these levels of implied volatility, they certainly can go lower. But the range in there for Bitcoin is probably about 40% or so. To 70% on the upside when you look at implied vol over the last year. I'm just buying call options in IBIT.
Okay.
Like that sounds kind of silly, right? I know it goes against, we want to sell premium here at times. There's no premium to sell.
Yeah. How far out in time?
I'm going out, let me double check and see what my actual expiration is here. It was like 200 days. Yeah, 200 days, November 21st, so end of the year. Give myself enough time. I just think the upside volatility is really cheap. You need a massive delta move, but on any sort of upside move here, you're going to see volatility come back into the marketplace. So I think there's an interesting setup. It doesn't mean that it's going to work. It's a lower probability trade, but arguably upside call options, tails, whatever you want to call them, are arguably cheap. I mean, cheaper than they have been for some time.
Yeah. And like you're saying, like, I think sometimes, and especially given, like, I think what tastylive posted on social today, which was like Tom rating different trading trends, and YOLO options was one of them. But I think there's a time and a place for something like that when you're saying, if you see something cheap on the board, you want to participate in a defined risk way. You know what the trade-offs are in terms of like putting capital aside for either long periods of time or understanding that in some asset classes, like that bullish behavior will actually, reduce the volatility or the price of that option. You just have to know what the trade-offs are.
Yeah, and there might be ways to finance it in the meantime, right? I was for a little while selling puts and just going to run the wheel strategy in there, though I never got assigned. So I was just selling cash secured puts or puts on margin in IBIT. But I don't really want to do that at these volatility levels either. Okay. So I'm comfortable with the small position that I have. I think I've got about $1,000 allocated to 3 different IBIT call options, and those strikes are 70, 85, and 90.
Okay.
And that's 200 days out. So it's a little bit of a lottery ticket. But in a world in which you absolutely see crypto prices explode, then I'm very excited to hold this position. Otherwise, it's just a trade like anything else.
Yeah. And I mean, to your point, like the 70s, the 85s, and the 90s, like, they're a little bit wide, but when you are just buying a single option, you can be a little bit pickier with your price.
Yeah, absolutely.
And I'm talking, when I say wide, I'm talking like 10 cents, 15 cents. So
yeah, the 85 is 6 cents wide.
Yeah.
Like you mentioned, the 70 is 15 cents wide right now.
Yeah. But if you look at the open interest, like clearly there's other people thinking the same thing.
Yeah.
So.
Yeah, this is a cheap way to get that exposure for maybe what's coming next.
Well, I might have to take a look at these because I currently in my portfolio do not have any IBIT. I was in a trade, I think it was like a crab trade with Nick, where I kind of rolled out a part of it and then covered the other bit on my own. So I'm in the market, as they say.
Well, volatility will probably go lower in the near term.
That's
but
okay.
Could present an opportunity. And given how much time you have here too, it's not like these options are going to go to zero in a week if the price doesn't go up.
For sure. And for me, like, and for those that maybe don't necessarily watch the show that me and Mike and Nick do, or you as well, like my typical bread and butter risk tolerance, like I like that $1,000 in spread width for a defined risk trade, maybe $1,500 in spread width, depending on, my conviction and or how many other trades I have on at the time. So if I am buying an out of the money 70 call in IBIT 200 days from now, $400 is in line with my other trade size. So it's not like imbalancing anything else that I would necessarily be doing.
Makes sense.
Love it.
Well, that's going
to be back.
Yeah, thanks for coming on the show, Katie. That's going to do it for our show here today. If there's anything that we didn't cover, you have a question on, shoot us an email, support@tastycrypto.com, or just hit us up on Twitter. You can hit up me, Katie, or @tastycrypto on Twitter, on X. But that's going to do it for our show. We will be back on Wednesday. Until then, I'm Ryan.
I'm Katie.
Peace.
Peace.